May 6th, 2010. It started like any other day on Wall Street. Traders were glued to their screens, the air thick with anticipation. Little did they know, they were about to witness history. At 2:32 p.m. Eastern Standard Time, the unthinkable happened. The market took a nosedive. Not just any dip, a full-blown trillion-dollar freefall. This was the flash crash of 2010. In just 36 minutes, the Dow Jones Industrial Average plummeted nearly 1,000 points, erasing $1 trillion of wealth. Investors watched in horror as their portfolios evaporated before their very eyes. The speed of the crash was breathtaking. In mere moments, the financial world was turned upside down. Traders, who had been calmly monitoring their screens, were suddenly thrown into a frenzy. The market, which had been relatively stable, was now in freefall. It was a scene of chaos and confusion, with everyone trying to make sense of what was happening. It was like watching a high-speed car wreck in slow motion. Every second seemed to stretch into an eternity as the market continued its downward spiral. The expressions on the faces of the traders told the story, a mix of shock, disbelief, and sheer panic. It was a moment that would be etched into their memories forever. The Dow Jones, a barometer of America's economic health, was bleeding out. The numbers on the screen were plummeting, and with each tick, the losses mounted. It was a stark reminder of how fragile the financial system can be, and how quickly things can change. By 2:47 p.m., just 15 minutes after the initial drop, over $1 trillion had vanished from the market. The speed and scale of the losses were unprecedented. It was as if a black hole had opened up, swallowing vast sums of money in an instant. The impact was felt across the globe, with markets in other countries also experiencing sharp declines. Blue-chip stocks, the bedrock of any diversified portfolio, were hammered. These were the companies that investors had always relied on for stability and steady returns. But on this day, even the most solid and dependable stocks were not spared. The losses were widespread and indiscriminate. Procter & Gamble, 3M, General Electric, all in freefall. These giants of industry, which had weathered countless storms in the past, were now caught in the maelstrom. Their stock prices were plummeting, and there seemed to be no end in sight. The sell-off was relentless, indiscriminate, and utterly terrifying. Traders were frantically making calls, trying to offload stocks before the prices dropped even further. The trading floor was a scene of utter chaos, with everyone trying to stay afloat in the midst of the storm. Then, almost as quickly as it began, the market rebounded. It was a sudden and unexpected turnaround. The same traders who had been in a state of panic just moments before were now breathing sighs of relief. The market was recovering, and the worst seemed to be over. By 3:07 p.m., the Dow had recovered most of its losses. The rapid recovery was almost as shocking as the initial crash. Traders were cautiously optimistic, celebrating small victories, but still wary of what might come next. The $1 trillion magically reappeared. But the trauma lingered. The events of that day left a lasting impact on everyone involved. It was a stark reminder of the volatility of the financial markets and the ever-present risk of sudden catastrophic losses. The scars from that day would take a long time to heal. The strangeness of the flash crash wasn't just about the speed or scale of the drop. It was a phenomenon that left even the most seasoned traders and financial analysts scratching their heads. In a matter of minutes, the market went from a state of relative stability to complete pandemonium. The chaos was palpable, with traders frantically trying to make sense of the numbers flashing before their eyes. It was the utter chaos in individual stocks that was most alarming. Blue-chip companies, the Apples and Exxons of the world, were suddenly trading for pennies a share. These are companies with solid financials, strong market positions, and a history of stable performance. Yet, in those moments, all that seemed to vanish. Accenture, a massive consulting firm, saw its stock price plummet from over $40 to a single cent. This wasn't just a minor glitch, it was a catastrophic failure of the market's mechanisms. For a few fleeting moments, you could have bought a multi-billion-dollar company for the price of a stick of gum. Imagine the implications of that. A company with thousands of employees, vast resources, and significant market influence, reduced to the value of a penny. This wasn't just unusual, it was downright bizarre. The flash crash exposed vulnerabilities in the market that many had never considered possible. It was a stark reminder of how interconnected and fragile our financial systems can be. It exposed a fundamental flaw at the heart of the market, a system seemingly gone haywire. The flash crash was a wake-up call, highlighting the need for better safeguards and more robust systems to prevent such a meltdown from happening again. It was a day that would be analysed and debated for years to come, a day when the market's facade of stability was shattered, revealing the chaos lurking just beneath the surface. In the aftermath of the crash, the question on everyone's lips was simple. What the heck just happened? The SEC, the Sheriff of Wall Street, launched a full-scale investigation. They pored over trading data, interviewed market makers, and chased down every lead. The initial suspicion fell on a fat finger trade, a typographical error that could have triggered the sell-off, but the evidence pointed elsewhere. The culprit, it turned out, was far more insidious and far more pervasive: high-frequency trading algorithms. High-frequency trading, or HFT, had been on the rise for years. These computer programs, armed with complex algorithms, could execute trades in milliseconds, far faster than any human. They were designed to exploit tiny discrepancies in the market, making money on razor-thin margins. On a normal day, HFT provided liquidity and efficiency, but on May 6th, these algorithms, programmed to react to market movements, went haywire. They detected the initial dip, misinterpreted it as a market crash, and went into a selling frenzy. It was a perfect storm of technology and human fallibility. The machines, it seemed, had turned on their masters. While the investigation initially focused on the broader role of HFT, it eventually zeroed in on a surprising suspect, Navinder Sarao. This unassuming trader, operating far from the bustling financial hubs, became the center of a global financial storm. Authorities were astounded to discover that the man behind the curtain was not a Wall Street insider, but a lone operator from a quiet London suburb. Operating from his parents' modest home in Hounslow, England, Sarao wasn't a Wall Street titan. His setup was far from the high-tech trading floors of New York or London. Instead, it was a simple home office, equipped with multiple computer screens and a high-speed internet connection. Yet, from this humble setting, he managed to shake the very foundations of the financial world. He was a lone wolf, a self-taught trader with a knack for technology. Sarao had no formal training in finance, but his sharp mind and relentless curiosity led him to master the intricacies of the market. He spent countless hours studying trading patterns, developing strategies, and honing his skills. His dedication paid off as he became adept at predicting market movements and exploiting them to his advantage. Sarao, dubbed the Hound of Hounslow by the press, had developed a sophisticated algorithm that allowed him to manipulate the futures market. This algorithm, a product of his deep understanding of market mechanics and programming, gave him an edge over other traders. It was a tool that could create artificial market conditions, giving the illusion of high demand or supply, and thus influencing the prices of assets. His program, known as a spoofing algorithm, placed and then rapidly cancelled large orders, creating the illusion of market depth and influencing prices. This deceptive practice tricked other traders into making decisions based on false information, allowing Sarao to profit from the resulting market movements. His actions went unnoticed for years, as he skillfully masked his activities amidst the vast sea of legitimate trades. On May 6th, Sarao's algorithm contributed to the downward pressure, adding fuel to the algorithmic fire. This day, known as the flash crash of 2010, saw the Dow Jones Industrial Average plummet nearly 1,000 points within minutes, only to recover shortly after. The event sent shockwaves through the financial community, leading to increased scrutiny of trading practices and the eventual unmasking of Sarao's activities. His story serves as a stark reminder of the power and potential dangers of technology in the financial markets. The flash crash was a wake-up call for regulators. It exposed the fragility of the financial system and the unintended consequences of unchecked technological advancement. In the aftermath, the SEC implemented a series of reforms aimed at preventing a repeat performance. They introduced circuit breakers designed to halt trading if stock prices fluctuate too rapidly. They strengthened rules around market manipulation, specifically targeting spoofing algorithms like Sarau's, and they increased scrutiny of HFT firms, requiring them to register with the SEC and submit to greater oversight. The million-dollar question, of course, is whether another flash crash is possible. The short answer is absolutely. While the reforms put in place after 2010 have undoubtedly made the market safer, the underlying vulnerabilities remain. The financial system is a complex ecosystem, and technology continues to evolve at a breakneck pace. New algorithms, new trading strategies, and new actors are constantly emerging. It's a constant game of cat and mouse between those who seek to exploit the system and those tasked with protecting it. The flash crash of 2010 was a stark reminder that we live in an age of algorithms. These lines of code, once confined to the realm of science fiction, now dictate our lives, from the news we consume to the investments we make. The challenge we face is ensuring that these algorithms serve us, not the other way around. We need transparency, oversight, and a healthy dose of skepticism when it comes to the brave new world of algorithmic trading. The future of the market, and perhaps our economy, depends on it.